Today on the Name a Better Duo podcast, we have Dom Walker. Dom Walker is a 2011 graduate of Clark Atlanta University, an author, Airbnb host, and commercial real estate investor specializing in out-of-state rentals. Dom is based in Los Angeles, California with his wife Brianna and daughter Bailey Ray. Dom has scaled his Midwest real estate investment portfolio to over $2.5 million with 17 units under management. He is focused on creating generational wealth and passive income while improving living conditions of his tenants and creating unforgettable experiences for his short-term rental guests. Understanding the importance of sharing knowledge within the Black community, in 2022, after securing his second commercial real estate property, he created an ebook called Don't Wait, Buy Real Estate. Don't Wait, Buy Real Estate is the blueprint to acquiring multifamily commercial real estate. Dom shares his invaluable experience throughout his real estate journey, highlighting his successes as well as oversights. You can find his ebook or paperback version currently available on Amazon or in the link of his Instagram bio at Deeds with Dom. Welcome, Dom Walker.
Thank you. I appreciate you having me definitely on the show. I'm just grateful to be here. Love to share some of my experiences throughout my journey with real estate in general, how I started, what I'm dealing with right now, and also my opportunities and goals in the future. So glad to be here. And hey, what's going on with you? And I know you've moved back to the East Coast. Yeah. I've literally seen you start this podcast. A year ago. So just to see you and just, how you've matriculated through the process, how you've grown, definitely proud of you. And how's everything going with your life?
Thank you so much. Things are good. I am adjusting to this East Coast weather again. Yeah. Missing the sunny Los Angeles at times, but no, everything is really, really good. And thank you so much for what you said. We're excited, as the people heard in your bio. You were doing major things with over $2.5 million invested in real estate. And the people want to know how they can get to that point as well. So we're going to hop into those questions after we start with this icebreaker, because I always like to get to know the person we're talking to first, okay, outside of what they do in their careers. So the first question I asked everyone, if you could hear any song again for the first time, what would it be?
And this is a tough one, but I have to go back to the Watch the Throne era, right? Mm-hmm. I'm a huge fan of Jay-Z, huge fan of Kanye West, and years ago, this is probably a decade ago. They collaborated and made a project, and obviously the song was called Niggas in Paris. Yeah. And back then, it just wasn't a lot of Black people going to Paris. I mean, that's why the song resonated so much. And I just think from obviously the production on the song to obviously the lyrics. It just really hit home for me. So for me to hear that, it really just inspired me to kind of just think out of the box. We had, two successful, Black individuals who just built an empire, one from New York, one from Chicago. Obviously, I'm from Chicago, and it just really hit home for me. We really got to get out here and go after our dreams, because anything is possible. So if I could choose any song, that's the one that I would choose.
That's so good. First of all, that was my jam. I remember where I was in Atlanta at the time, and it was just a good time. And then also the perspective of that, I know at that time, I didn't know a lot of Black people that had been to Paris,
Yeah. I mean, it was definitely that perspective. People were, we weren't really going to Europe. We weren't going overseas yet. Mm-hmm. And I think, they had started to turn that chapter for us. So, yeah. It was an exciting time in hip hop, exciting time, just in history.
That's good. That's good. So we're kind of shift gears in this next question. There's so many people, even in our community, who are making strides in the financial world. Who are some of your financial icons?
Oh man, this is It's so many of them. But if I kind of just trickle down to just on the topic that we were just talking about, Jay-Z. I mean, it's just very inspiring business person. Just from the type of deals that he does, his forward future thinking, just his involvement in so many different categories. I just think it's just amazing, right? The guys involved in, just the food and beverage category, liquor category, sports, and obviously hip hop, and we can go on and kind of just go down the list, right? But I think every specific business that he has or business decision that he has made, it's just inspired the Black community, and I just love that. Also, years ago, decades ago, his rival Nas. Nas is a huge person in hip hop, but as he made his transition into the tech industry, one of his biggest or largest investments was in the startup side of the business, specifically with Ring. And if you look around at majority of houses, homes, apartments, there's not plenty of homes without one, right? Everybody wants to know who came to their door, who left, what did they do, things like that. So for him to make that significant investment in that startup really just blows me away. And just as we trickle down into real estate, there's an investment group out in Chicago. They're Chicago-based called Oasis Investment Group. And I just think they're doing some really great things as far as building a syndication for the community to come to. Obviously, they're Black owned, Black leadership, and they are buying back the communities in Chicago. And not only are they doing that, they're investing in the knowledge of the students out there on the ground. They're doing field trips and showing them different rehab properties, commercial real estate, and also residential. So, those are some people that are out on my radar. Definitely love what they're doing. And then, I'm based in Los Angeles. So, there's a big real estate person out here. His name is Sam. He really focuses on real estate on the commercial side in Orange County. And he has just been very, very successful with buying commercial office spaces, large buildings, and, just going through that process of transitioning, those spaces to medical facilities, building them out, making them better, getting them leased up, and then selling them again. So, those are all the different people that are on my radar. And like I said, I'm just in the space where I'm just learning a lot and just trying to, continue to develop as well.
That's awesome. That's a great list, first of all. And I love what you brought up with Jay-Z, because we talk a lot about having multiple streams of revenue, right? And he's got his hand in so many different cookie jars, but it's that's why he's where he is financially. And that's one of our icons. So we can definitely learn a lot of lessons from everyone that you just listed. You mentioned, and we see your book behind you, Don't Wait, Buy Real Estate. And I believe in your book, you mentioned about knowing your why. What is who is your why?
Yeah, I think that's a great question. And again, when I start the book off, I start with that because that's going to determine the direction that you take with, however which way your real estate journey goes, because you got to know yourself, you got to know your why, right? There's a lot of different facets and a lot of different ways you can go with this. You can get into wholesaling, you can get into flipping homes, you can get into buying commercial real estate. You got to understand yourself and your strong suits, because you don't want to go down a path where, hey, maybe I'm just, not good at, flipping homes. I don't have experience with that. I don't have any connections on that side of the playing field. So if I just want to jump into something just because it looks great, you just want to watch what you're getting into and kind of play to your strengths, rather than, just taking a shot out in the dark. And specifically my why in my situation was, really just building generational wealth. I'm a strong, avid believer in building wealth over time, and real estate is just tried and true. It's just proven to actually perform and be an asset that can be passed down generation to generation, right? So as I look at the stock market, again, I'm not, a financial advisor, disclaimer, but as I look at the stock market, it's a great place to be at, if you have that experience, if you know what you're doing, right? As I look at real estate, the difference between the two, a bank is not going to give you a loan to get started in the stock market. It's just not going to be backed, right? So banks are avid believers and strong believers in real estate, right? They understand that real estate is less volatile than the stock market, and they're willing to actually fund a certain percentage of your deal because it's tried and true, and it can be passed down generation to generation, right? So that's my why, just really creating generational wealth, passive income for my family, and building pretty much a legacy for my last name.
I love that. I love that. So important. So let's hop into these questions. What first interested you in real estate?
Oh man, I initially got into real estate, and I can kind of track this all the way back to when I was in corporate America. I was graduating college. I was recruited into a rotational sales development program where it basically required me to kind of move in different markets throughout the United States. So I was in Atlanta, I was in Ohio, several cities throughout Ohio. And I just got to the point where, I was in my third or fourth year, and I started thinking like, hey, I'm making decent money, but I'm seeing, a lot of different real estate around me. I want to get involved, but I just didn't know how to. And throughout that process, I'm also learning that, hey, I'm climbing the corporate ladder, but at the end of the day, I don't own it. I don't own the income. I don't own, the position. If my job were to let me go today, I couldn't pass it down to, my daughter or my family, right? So I needed something that I could actually own. I needed to provide some assets for myself that could in turn give me the cash flow that I needed to sustain myself and my family. So that's one of the reasons why I got interested in real estate. I chose it. I knew I was already passionate about it. I just needed to make a decision and get into the game, right? So initially, I ended up purchasing my first property back in 2017. I got into the market in the south side of Chicago. And I ended up buying my first property. It was a condo in a great location right outside of Chicago. And, hey, it was just all said and done after that. I really just continued to just grow within real estate and explore different facets and different avenues of it.
Yeah. I love that you brought up your transition out of corporate America, because I feel like, one of the purposes of this podcast in particular is to just kind of motivate people to think outside of the box. And I think that especially with our generation and generations before us, we were conditioned rather to believe that that's what you do. You graduate college, you get you a good paying job with benefits, and, hopefully get a pension, and that's just the trajectory of your life. But we are now being open to so many more opportunities where hopefully our children won't have to work as hard as we did, that we'll be able to open some doors for them, that they can have that wealth that we created, the stuff that we see on TV and what we see in other communities, we'll be able to do for our families by stepping outside of the box. So I love that you share that. I love that you were able to do that. And now you're creating exactly what you hope for your family. How did you transition into commercial real estate?
A great question. Again, I purchased my first property in 2017. It was a condo, 3-bed, 2-bath. You know, the unit was pretty much already turnkey property, was already built out. And I had Thanksgiving. I was so excited. Like, I purchased my first property, I had Thanksgiving at this property with my whole family. And throughout that journey, you kind of, as soon as you get into real estate, you kind of, you know, already kind of have your eyes set on different people that you kind of want to just seek mentorship after, right? And luckily for me, one of those individuals was a close friend of a family member. And great opportunity, had them over for Thanksgiving and took them around a tour of the property. You know, showed them, you know, some of the upgrades, showed them, you know, some of the designs. And then, you know, when you get into real estate, you kind of start understanding that, you know, hey, actually, when you're talking to other people in real estate, it gets down to the numbers, right? So, okay, nice place, but okay, how much did you pay for this deal, right? How much did it cost you out of pocket? What was your bottom line? So as we started to trickle down that process of the actual numbers of the deal, I was just completely blown away. My mentor, that's currently my mentor now, he actually told me that, you know, hey, this is a great purchase, great location, but for what you paid for this, you actually could have got a multifamily property. And you know, obviously with the condo that I had, you know, it was only one door to that property. And based on my purchase price, I paid about $190,000. Based on that purchase price, I could have got either a 3-unit or a duplex, you know, for that price at that time back in 2017. So it was just shocking and eye-opening for me. And as soon as I actually heard that feedback from him, I began to dive in. I began to, you know, really reach out on a monthly basis. You know, now I'm talking to him every week, but just reaching out and kind of setting up mentorship, right? How did you get started in commercial real estate? And how can you take me from residential to commercial? What steps do I need to take? And really, what's the mindset shift that needs to happen for me to actually get into this game? So that was literally my shift right there. And fast forward to 2020, after just, you know, being in his mentorship program and just him guiding me through different deals that he's done, I kind of I understood what I needed to do myself to get started, from a down payment perspective, just from overall paperwork perspective with, you know, obviously taxes and paperwork, W-2s, what you need to provide to get qualified. Obviously your, you know, personal finance statement, just things like that to obviously come prepared to a lender. And then 2020, I was able to make my first purchase with a commercial property. And through his mentorship, obviously he's been in the game. You know, once you find a mentor, they've obviously been in the game a lot longer than you. So it was just great because we were able to kind of, you know, locate some off-market deals just by me, you know, just fostering and nurturing that relationship. And that was, you know, just completely key because just finding these off-market deals were 100% key. It was a lot better than just taking a shot out in the dark and buying just randomly on the market, right? So that's kind of how I made my shift through commercial real estate, and I just continued to foster that relationship with my mentor and continue to grow my portfolio at the same time.
There's so many gems dropped there. First off, mentorship. You know, like a lot of us don't do because of a lack of knowledge. But if we are able to find, there's always people, just you know, and putting your information in this book and sharing what you've learned, like, you know, you want to help the next person, you know, and there's so many people out there who are willing to advise you and help you along the process and along the way. And it's so important to like find people who are doing the things that you would like to do and aspire to, or being what you aspire to be, to kind of just like hold your hand through the process, or just to be able to go to for advice, and you know, you can put back into them as well. So that is so key. And for you to be able to like take that information, you know, and go with it, because I think it's so much easier, you know, to have a dream and to think, okay, I want to do this, but when you see someone else who has done it, you know, it makes it so much easier to have them along the way. So you talked about, you know, the process of purchasing your condo in comparison to getting this commercial real estate. How would you compare those two processes?
Man, great question. I think, and this is one of the main reasons why I stress, even if you're starting off in real estate early, even if, you know, this is maybe your first or second deal, I completely stress going all the way, getting something that's on the commercial side. And if you don't get anything on the commercial side, you know, getting maybe anywhere between a 2 to 4 unit, you know, multifamily property. My program and everything that I invest, you know, literally starting from 2020 all the way up until now, I only do multifamily deals, specifically on the commercial side. But to answer your question, the condo deal versus a commercial deal was equally, you know, as difficult, right? And I was only buying one door. I was only buying one condominium, right? So specifically with my condo deal, I'll kind of speak to that because that actually was a little bit more difficult than my commercial deal.
Wow.
And typically, you know, hey, you're only buying, you know, one door, you're only buying a condominium. Why would that be more difficult than a big apartment complex, right? Well, and at the time that I was purchasing, you know, the condo, obviously I was purchasing that through a first time home buyers program, right? Where, hey, if it's your first time buying a home or purchasing a property, the bank has a set aside program that's funded through the federal government to actually cover your down payment, right? So now the bank has a little bit more of a criteria that they hold your your condo building towards, right? So the condo building has to be, you know, obviously certified in the structure. They want to speak to the president of the association about the HOA, right? They want to speak about the reserves. How much funds does the building have to support, you know, future expenses of the building? All of these, you know, issues are completely out of your control. You're just trying to go in and buy a unit, right?
Right.
So through that process, it kind of held up a lot of things because these were funds coming from the federal government to cover my down payment. So the bank was super anal that the association had to have everything tight, clean. Everything had to add up. They wanted to see financial documents of a couple of years back. They wanted to make sure the unit was, you know, obviously just registered with the city correctly. I was running into issues from the last owner that, you know, obviously just didn't have the property registered correctly. So the deal kind of just took a long time. I was in that deal for like 5 to 6 months before it closed. And specifically with my multifamily 5-unit commercial deal, this is the first apartment deal that I've ever purchased. I closed on this deal maybe less than 2 months. And you know, the difference between the two is, you know, with commercial, you know, you're walking in buying a business. Anything over 5 or more units is considered a commercial deal. So the down payment is a lot different from a residential property. Commercial, you're putting down 20 to 25%. So let's say the building was 500,000, 20% of that would be $100,000. And then, you know, obviously you're purchasing that building under your business name. You're not purchasing the building under your personal name. So, the debt to income ratio factors aren't such of not a I wouldn't say issue. They're just not so much of a hurdle with commercial because you're really getting qualified just based on your personal finances, but really on the asset itself. How much income is it producing and what are the expenses on the building, correct? So my commercial deal was a lot more smoother, a lot more, less hurdles versus my first condo deal that I've ever purchased. And to wrap this question up, I would just go directly to a commercial multifamily. You'll pat yourself on the back when you look up 5 years later, because now you have 5 units, contributing to your bottom line every year. And yeah, my condo unit, I still own it. But again, there's a lot of, things that I have to jump through with HOAs. I just saw something on the internet the other day, and it was by Lil Duval, and he said, hey, those HOA presidents, they act like they're your landlord.
Listen.
And it's true because they're reaching out to you about a checklist of things that they want you to kind of abide by and do this and do that, and you have full ownership of the unit. So why should somebody be able to tell you what to do? So I could go on and on about this topic, but if I could have done it all over again, I would definitely get a multifamily building first.
That is so interesting, because one of the next question I was going to ask you is what are some of the misconceptions of first-time real estate investors that you get? But I think that is one of them. For me personally, even I just thought that it would be so much more difficult, to get your hands on commercial real estate because, like you think that, first of all, you have to have more money down, and you would think that there would just be so many more expectations coming in as a business, and like you're making money off of this property. But to hear that the hurdles were that much more for a personal property is very interesting.
And again, every deal is different. Everybody's financial background is different. It's I was going into that deal buying a condo, so I had to deal with the condo HOA piece, but I also was getting the down payment funded by the federal government. So everything had to check out. So when you're coming in with 20% on deals, there's not much question. The bank sees that you're crazy. I mean, not crazy, but yeah, you're pretty much serious about the property. So when you're coming in with 20%, not many questions are asked.
That's good. So how can someone know that they're ready to start jumping into real estate? Like, do we need to have a certain amount of money saved or a certain percentage of the purchase of the home? Like, how can someone know, okay, I'm ready?
Yeah. And I think this all dates back to every individual has, they have their own goals, right? You have to understand your why. You have to understand what is your overall objective. Because right now, I could throw a number out there, but obviously that would probably only speak to one specific person, right? So I just think it backs back to, okay, if you're looking for something just to get into home ownership, right? I want to own an asset. I want to own my own home. I want to be a homeowner, and I want this home to appreciate over time so I can build equity and leverage the equity in the future to invest in property, right? So in this specific case, I want to speak to the individuals who are sitting out there and just waiting their situation is just completely perfect, right? I gotta wait till next year because my credit is a 650 right now. I need a 700. Or, I need to get some things cleared up on my taxes. If you are going into home ownerships to just occupy a home and build equity in the future, you should not be waiting to build 20% down payment, right? You just don't need to, because if just an example, like what happened with COVID 2020. A lot of individuals probably waited till COVID was over and to actually purchase. But if they would have did it prior, and maybe just put 5% down on that property, right? The average home that actually appreciated in California was over like 120%. So, the equity that you miss out on waiting, specifically just with single family homes, and trying to make sure your situation is just perfect, right? Right credit, the right taxes, the right down payment. You're missing out on free, appreciation that you could actually just take advantage of just walking into that property with 5% down.
Yeah.
Now, on the flip side, if you are a person like myself and you were at a point where like, hey, I've been in corporate for a while. Now I'm looking to own some assets and actually appreciate, but also my main goal is monthly passive cash flow, right? I'm trying to actually replace the income that I actually was generating, through corporate America or through whatever, segment that you were actually generating income with. So in that case, you're buying a business. So when you go in and buy a business, you don't want to go in and, have, 5% down into the business. You want to have some skin in the game. You want to make sure this business is making sense financially, right? How can you walk into a business and only put 5% down and expect these huge ROI returns?
Yeah.
So, you want to walk in with 20% down. That's what I would suggest, walking into multifamily. And you'll understand that, hey, as you get into future and more deals, the deals get better, as they go on. But after you put your 20% down or 25% down on your first couple of deals, you're able to understand how to find deals off market at a discount, right? So now you're able to find deals with equity in them. So you're walking into the deal with maybe 40, 50, 100,000 equity. Just based on you having the resources to put together an off-market deal. And maybe now you don't have to put down 20% down. Maybe you can walk in with 10 or 15 and leverage some of that equity that the deal already has into it, and the bank can still fund the deal. So those are a couple strategies that you can actually, look at when kind of jumping into, multifamily real estate. At the end of the day, you just don't have to have as much as you think, but it's more so about your goals as well. Are you walking into the deal just looking for appreciation and equity and building equity over time? Or do you want this thing to make sense right away? And for me, that's what I need.
Mm-hmm.
If I'm going to put $100,000 down on an apartment building, then okay, I need to be seeing about $3,000 a month. I can't actually walk into a deal without seeing those numbers, because I want to make sure my money is making sense. So I think, again, if you're out there and you're looking to actually get started investing, you got to understand your goals first. Are you just looking for appreciation, or are you looking for cash flow?
More gems. I was going to ask that because you had mentioned about, gaining equity, or using that equity in the purchase of the next home. Like, are they looking at, okay, you have this amount of equity in one property, are now you getting another line of credit based on that equity? Or like, how does that work in terms of purchasing multiple homes? Because I would think, okay, they're looking at that as a liability just because you still owe this amount on that home purchase. So how does that work in terms of helping you purchase your next property?
Yeah, for sure. So when you go into purchasing your third, fourth, fifth, sixth property, right? Every time you enter the deal, the lender is going to ask for, hey, we need to see your tax returns, and we also need to see your personal financial statement. On that personal financial statement, it's going to outline every specific property that you own and your exact position on them.
Mm-hmm.
So also on the personal financial statement, I mean, obviously it's going to ask for your bottom line. What's in your bank account?
Mm-hmm.
What type of credit card debt you got? But to your question, it's going to ask for the properties that you do have equity in. So it's like I said, if you have 2 or 3 properties that have $60,000 to $80,000 worth of equity in them, then your net worth at the end of that personal financial statement is actually going to show obviously a positive net worth, right? And based on that, they're going to be able to make a decision on approving you on that next deal, because guess what? You are going to guarantee that purchase. You may purchase it under a business name or under LLC, under trust, whatever process you go, but based on your personal financial statement, you have enough leverage and collateral to personally guarantee that transaction. And they basically have built enough trust into you to actually fund the transaction, because they know that, hey, if something were ever to happen, Renee has equity in these two properties, and we can actually come after those two to actually get the funds back for this property. Mm-hmm. So I think just you knowing your position on those specific properties and knowing how to effectively communicate that to a lender, that will get you approved for your next deals.
That's good. That's very helpful information. I know a lot of our viewers are very new to real estate and, want to jump into other, besides just purchasing their own home, the possibility of having commercial real estate, but just not knowing where to start. So that is very, very important information. Make sure you're taking notes, folks. So what are some of the greatest challenges of being a landlord?
Oh man, I deal with them every day. Mm-hmm. Every single day. And I think this is kind of like a twofold question, because, being a landlord, you try to walk into the business as an investor, right? Obviously, you have property management managing your deals as well, but there's a thin line between being that investor and also being a landlord. How involved are you going to be in the process? And you have to make that decision for yourself walking into the deal. Do you have enough cash flow? Is the deal healthy enough for you to hire a property manager and completely be hands off? So that will make a complete difference in some of your challenges and headaches with the property. But the reason why I go down that, this is a twofold question, because real estate, as much as it is like a financial, business, it's also a people business. And you got to kind of understand that walking into these deals, you may walk into an apartment complex that, already has tenants fully occupied in that building. And your job as a landlord is to walk into that deal and understand that, hey, I have to formally and effectively, and just from an overall like people perspective, you have to communicate to them that, hey, the building is under new ownership, right? And with that being said, the previous owner, probably owned it forever, right? They actually had the equity in the property to allow some of the tenants to pay below market rents, correct? Allow some of the tenants to just operate as such, or as they want. And with you coming in with the new operating cost, your mortgage is a lot higher than the previous owner. Expenses are higher. They might not even have a mortgage, the people that you bought it from. So at the end of the day, you kind of got to understand it's a people business first. So you don't want to go in raising rents and evicting people, the first month you buy the property. You want to have that conversation with them, hey, with me acquiring this new building, the operating expenses have completely changed with inflation, and just based on some of the comps in the area that you can actually get from your real estate agent, or you can kind of look on a Rentometer. You've got to, kind of just break it down to them and say, hey, here's where you guys are, from a rent perspective, here's what you're paying, and then here's where the market is. Mm-hmm. And, based on the new expenses, by this date, I'm going to need to actually bring rents, whole. And, you're not going to do that overnight, but maybe you give them, I don't know, 6 months, and you're going to walk into situations where you've had tenants occupying this building, and they weren't even paying the last owner. Not your problem, but now it is because you own the building. So um, again, in this situation, you don't want to go in completely evicting folks immediately, because again, this is a people business, and for some people, this might be their last home, their last apartment. So again, you want to kind of put together some type of plan to get them back on track. And if that's not working, again, I give, again, I result back to this is a business. So I'm first a people person, so I may give you a full year to figure out what type of plan we can work out financially to get you back on track. But at some point, you got to understand that you have a family and you have expenses as well. So after a year, it's just like, hey, I understand that you've been a veteran at this property, but here was the timeline that we put together to actually, get through some of the challenges or work through them. And unfortunately, the eviction process has to begin, and you have to exit after that year. So you can't, beat yourself up, but you just got to understand that it's a thin line between actually being a people person, but also running a business. Mm-hmm. These tenants out here, specifically in markets where it's more of a landlord, a tenant-friendly state versus a landlord-friendly state. You'd be surprised. These tenants might play, stupid or play dumb, but they understand the laws. Mm-hmm. And they understand how to play the game. They understand how to play you. So at some point, you got to draw the line, and you got to say, hey, at this point, here's the time frame that I'm giving you, and the evictions process will begin on this date. And I've already opened up my doors to you. I've already kind of catered to you. But at the end of the day, again, that's one of the biggest challenges with being a landlord. Understanding, hey, when it's time to go for some tenants, who are the problem tenants, but also, just understanding your financial background. And then the second piece is really just the day-to-day, repairs, expenses, coordination between folks. You're going to have turnover between units. You're going to have property management that needs to go and kind of meet the city to inspect the building. You're going to have property management that needs to repair, different things in different units. So I think it's just a lot of coordination, a lot of tasks to be on top of. And oftentimes people don't understand that you have to manage your property managers as well to make sure that they're executing their end of the deal. So yeah, just being a people person and kind of understanding that financial background of the business is a challenge, but also just the coordination of just the project management of each address that you own can be challenging.
Yeah. Man, I can only imagine. And that was something I never thought of. Like, you talk about this in your book as well. Like, initially you might think it's a good thing that you're coming into this property with tenants. However, you don't think about the fact that now my mortgage is a lot higher if he might not even, or she may not have even had a mortgage anymore, so I charge this person more. And now I have to communicate that, where the people skills come in, but then I also have to put my foot down where the business skills come in. So thinking of all those things, and then the importance of having, if you're able to, property management, because like in your case, your commercial units are out of state, correct?
Correct. Out of state investor, and specifically with multifamily real estate, because I'm based in California, but things are just a lot expensive out here, or a lot more expensive. And the type of return that I need to see on a monthly basis, California, you're going to appreciate a lot more than the Midwest. But you're not going to see a monthly return, right? You're just going to be kind of just making the mortgage payment and kind of betting on appreciation. And, I'm all about that cash flow.
And you also stress the importance of research. And that's where that comes in, to even be able to determine where is best to buy for you, right? So like, to know what it is you're looking for. If you're looking for that cash flow, then you need to research what areas are going to provide that for you. So that's so Important. And I want to highlight your book because we talked about it a little bit. I have the ebook version here. Don't Wait, Buy Real Estate.
Oh, appreciate it. Thank you.
Make sure you are purchasing it. So many, all the information that Dom is sharing with us and then some is in this book. And you talk about when you're advising potential buyers, you know, to get, because a lot of people don't have the funds, like you're talking about the 25% to put down that down payment, but to use OPM, other people's money, to assist, whether it be in financing or what have you. What are some of the pros and cons that you say come with getting that down payment finance?
Yeah, for sure. I kind of just revert back to just kind of an example that recently I've one of my other partners, and this isn't a deal that I'm involved with, but this is a deal that he got done, and it just also depends on how aggressively you want to scale your business. Are you willing to go to different measures to get the deal done? How confident are you in the deal? And sometimes it takes, hey, I may have just bought a 10-unit apartment building 5-6 months ago, but I see another one right now, right? Mm-hmm. I see another one now. And I've already exhausted some down payment funds on the purchase that I saw 4 to 5 months ago. So this new deal, I don't want to let it go. I got it under contract and I need to figure out how I'm going to acquire this deal. So many people use OPM, and it's a strategy to aggressively scale your real estate business without coming out of anything out of pocket initially. And one of the great benefits of it is that you're going to leverage the bank's 80% to actually purchase the property. They're going to fund the loan, but also you're going to search out and kind of just acquire private funds from a private lender to cover your initial 20% down payment. So now you got this private lender coming in with those funds, and then you also connected them with the commercial lender. You're able to walk into a deal without coming out of anything out of pocket, and the deal is purchased either under your name, under your LLC, and you own that deal, right? So some of the disadvantages of doing it this way is that if your goal is monthly positive cash flow, that you're putting, maybe you had a goal of $2,000-$3,000 that you wanted to put in your pocket from a multifamily apartment building, but hey, you just got this private loan for the down payment, plus the bank wants their monthly mortgage. Hey, maybe for the first couple of years, you won't see any passive positive cash flow. And it's just based on the expenses that you have on that building. Now you're at a point where, hey, I didn't put anything down, but I'm going to hold this asset. I'm going to let the tenants pay the mortgage and also the down payment that I owe, back to the private funding, company. But you're going to hold this building over 3 to 4 years, and the building is going to appreciate. On average, a building appreciates on average 3%. That's very conservative, 3% year over year. So if you're talking, purchasing a $500,000 building, again, you got the funds from private, you got the commercial funds, it's going to appreciate $15K a year. So you waited 4 years, and now at this point, you're able to refinance out of that deal, pull some equity out, pay off your private lender, and now you're able to significantly take advantage of positive cash flow every month. And you paid off your private lender. So now, hey, now you own the deal without coming out of anything down payment wise out of pocket. And it's just a great strategy for scaling your business a lot quicker than, it just depends on how long would it take you to come up with 20%. That might have taken you another 2 to 3 years, right? Just depending on, how your cash comes in. So if you're able to get into a deal a lot quicker, maybe 3 years before, and let the equity play that ball game, I think is a great strategy. You just have to be willing to understand that, hey, I'm not going to be receiving strong returns monthly on the property. That's going to be further down the line.
Yeah. But then that's just proof that there are, the possibilities. There's other possibilities besides just, we think, a lot of us, I got to save this amount of money, but to know that there's other ways of entry into this industry is so encouraging, I feel like, because that's something that discourages a lot of people, especially for something that's so unique and so new to so many of us. Is like, we always want to buy a house, but to think that I can actually be an investor, and turn this into something down the line. Because when you think of starting any business as an entrepreneur, it takes a few years to actually see profit, So if you go into it with that mindset, it's like, okay, I'm investing in something that in a few years, I'm going to start seeing that monthly income. Right now, I have to make the sacrifice, but it's going to pay off in a few years. That's encouraging.
For sure, it is.
That's really encouraging. And you brought up, how the market shifted during COVID. I want to touch on, because I know a lot of people right now are very leery because of the interest rates. How do you feel about the real estate market right now? Is it a good time to invest, or is it something that we need to hold off on and do more research until things kind of even out?
Yeah. And, there's, everybody has their own perspective about the real estate market right now. It just depends on, how serious, you are as, running the numbers on the deal, right? Also, when interest rates are high like this, what people don't understand it scares a lot of buyers out, because obviously they can't afford the number that, they, traditionally were looking at. But, what I would stress is, when interest rates increase, normally the property values decrease, because now these sellers, they have to take a price hit because they have to actually market to buyers that can afford a property at a specific price point. So at this point, interest rates have risen, property values have actually took a slight hit. And, and it happens vice versa. When interest rates actually go lower, 2 and 3%, these buyers are out here paying 100,000 above asking, right? 200,000 above asking price, because, with that low interest rate, they're able to still maintain that monthly mortgage payment. So what I always tell people is, during this time, I am aggressively looking for deals as we speak right now. It's not because not a lot of people out there, well, it's less buyers out here, but it's not because I'm scared. It's not because I just really, really need a property. It's really because when you understand that debt doesn't change, the purchase price that you actually get a property for, that won't change. You can always change your interest rate when you understand the refinance game, when you understand capitalizing on the time is right with a great credit score and great interest rates. You will understand that, hey, right now actually is a great time to purchase, because now, for instance, in California, a property that was 1.3 or 1.4 million, you actually can step into that property right now for maybe 1.15 or 1.2, because interest rates are 7%, right? So I think, to answer your question, it's a twofold again. You got to look at your budget. You got to look at your income. Can you afford the monthly payment for maybe a couple of years, maybe a year? Because these interest rates aren't going to be 7% forever. Everybody knows that, and nobody just knows when it's going to go down. So are you able to weather the storm for maybe a year or two, and then refinance and capitalize on that equity when rates go down? Because you got to look at it like this: if you're able to walk into a property with a 7% interest rate, which is hey, it's not good, right? 7%, not good. But if you're able to walk into $1 million property, right, with a 7% interest rate that when rates go down, it's going to be worth 1.35, right? So if you're able to capitalize on that opportunity now, just based on your budget, I would automatically tell you to go after it, because you're going to pat yourself on the back when you look up in this 2024, 2025, and you are walking around here, in a position to potentially sell the property, or you refinance, bought your rate down to 3% and took some cash out. Now you're ready to go invest in the next deal. So that's my whole kind of just perspective with high interest rates. I really don't care how high the interest rate is, because I know the Fed is just trying to hedge against inflation. And when they're trying to do this, they can't do this forever. So it's just like the stock market. When people are scared to buy, that's the time to go ahead and get your finances in order and snatch something up. Because when prices hit the all-time high, that's the time to take the exit. So that's my perspective on the high interest rates.
No, that's so good. I think that we need to stop paying so much attention to the headlines, because they do try to, scare you in a way. And you see the high interest rates and you're like, oh no, it's a terrible time to buy. But for you to realize, no, the house rates are probably going down, which I've noticed they definitely are. So like you said, refinance in a year or two or however long, once the interest rates go back down. It's such a gem once again. So you're also in, you do Airbnb. I want to talk about the difference between, or like the pros and cons between Airbnb, short-term rentals, and having a tenant on like a 12-month lease.
Yeah, for sure. Great question. And I would say it's two different strategies and advantages and disadvantages on both sides. And with Airbnb, it's amazing, right? Because you're able to be a lot more flexible. Hey, if you want to occupy that specific space or that property throughout that month, you can, because you can kind of be flexible and block off the dates and kind of take advantage of that. You're also going to be able to generate a lot more income from a short-term rental perspective versus a long-term lease, right? So the income and the margins are just a lot higher with Airbnb than a long-term contractual lease. And, it's really because you're able to maximize 30 days out of the month versus just one normal rate. You lease a unit and, obviously, that's it. But what a lot of people don't think about is with Airbnb, there's some disadvantages as well. A lot of times, Airbnb says they're screening to your tenants, but there's some bad apples out there that may not respect your property as much as you do. So you definitely can't turn a blind eye to that. You also can't turn a blind eye to how much you want to work, right? With Airbnb, you're going to be turning your units. You're going to be specifically cleaning them maybe twice, 3 times a week, right? That coordination and project management and just being seamless, catering to your guests, because Airbnb is hospitality. As much as people think it's real estate, it's a hospitality business. You want to make sure your guests have the best recommendations to the city. You want to make sure that they have the best accommodations inside the unit. And that can be a lot more just on your mind than versus, a long-term tenant that can just move in, and maybe there might be a repair that you might have to address maybe every other month or maybe once every 6 months. So I think that's the biggest difference. But to answer your question, I think what people really truly need to look at is the goal should always be home ownership. And although, hey, with Airbnb, you don't have to put these 20% down payments to walk into the deal. You can kind of do the corporate arbitrage, strategy and kind of just lease units and rent them out through Airbnb and VRBO. What you're taking advantage there of is you're doing a lot of work and paying the apartment building's mortgage. You're also really, 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 just not necessarily burning yourself out, but you are doing a lot of just cleaning and just replacing furniture and keeping up with your unit. And that's a lot of the things that people don't talk about when they have these successful Airbnbs. How many times did you have to paint the unit or replace furniture? And on that side of it, you're only taking advantage of that monthly income. With Airbnb, literally, let's say you're making $4,500 a month off, a specific high-rise unit. And with that said, $4,500 a month is really the cash flow that you're really only taking advantage of. So you could also go buy a $500,000 apartment building, right? And you can Airbnb those units. And with that being said, now you have one Airbnb in the building, but you have long-term tenants throughout that building, right? So if you go that strategy, now you own the building. You are also taking advantage of tax benefits. On a $500,000 property, that property is going to conservatively, appreciate 3% year over year. So you're taking advantages of appreciation, tax benefits, also debt pay down. Your tenants are going to be paying down your mortgage on average, specifically with a $500,000 property. They're going to be paying that mortgage down $10K a year. So not only are you receiving tax benefits off of your annual gross bonus depreciation tax benefits specifically, you're also, acquiring appreciation. You're also, really taking advantages of other tenants paying down your mortgage. And then you might not be making $4,500 off of, apartment complex, but you might be making $2,000 off of, passive income off of those tenants paying. So those are kind of like the two differences between like just running straight forward with Airbnb. Again, you have no down payment, but you're making a lot of cash flow monthly. But on the flip side of it, with a long-term contractual lease, you're making less cash flow a month, but you're taking advantage of appreciation. Again, you own the building. You have tax benefits for your taxes on an annual basis. And then lastly, tenants are paying down, your debt, and you're appreciating your value. So I think, the goal should always be home ownership. And if you can kind of just drill that down into your process, you'll be successful.
That's such a great point. I think a lot of people, myself included, go about it with I think people are afraid of debt, afraid of having a loan. They're thinking of oh my goodness, it's 30-year loan. It's intimidating, but if you go about it like a business, you're expecting to be able to pay that off, in less than 30 years even, and I know for me, I did that where I had 2 apartments in LA. I did Airbnb in one of them. And once complaints start coming in, they can tell you to stop, the owners but when you're an owner, you are controlling that, and you get to decide, whether or not, you want to continue doing Airbnb or not. So, that is one of the major benefits to me, in that, you own this. This is your property. You can do what you want to do with it. Whereas there's still going to be control over there. And you are not, like you said, you're helping someone else pay their mortgage where you could be paying your own and getting those benefits. So such
great. And I think you bring up a good point, because I think one of the biggest things with me, starting off, and when Airbnb really kind of just got on my radar, and I think this is a good example of people investing in neighborhoods that, may be an eyesore, right? The area is just being gentrified, but it's not quite there yet. And we kind of understand within our communities, there are going to be areas that are very attractive financially for us to actually go and invest in those communities. But something holds us back for whatever reason. We say, hey, this might be an eyesore. I don't think, Airbnbers would be interested in staying in this area. And specifically, when I purchased my first property in 2017, the area was being re-gentrified. It was being, just cleaned up and it was an eyesore. But what I completely and I quickly understood is that Airbnb guests, they care a lot more about proximity than the surrounding areas and how the area looks to the eye. For example, that unit was maybe 7 or 8 minutes from downtown. So proximity was a lot more of a huge factor for Airbnbers because they're not living in the city that you are Airbnbing in. They're flying in and they just want something that's close and the inside is very, accommodable to actually what they're currently living in, right? So that's what I knew, and I found out very, very quickly from Airbnb. It's all about proximity, and that listing has just done very, very significantly well this year. It's actually outperformed one of my multifamily buildings.
Oh, wow.
And I own that property, right? So that's why I 100% preach ownership because, hey, if one strategy with long-term tenants is not working out for you, you can actually switch up and transition to Airbnb.
That's so good too. That is so good too. Cause that was what I noticed too. Cause same thing. I was by USC, which can be a sketchy looking area to some people, but you make the inside look nice, which is what people really care about, the decor. And then when you think about like what people are coming in town for when they're visiting, they're going to an event or they're going to, like they want to be there for something. And a lot of time like events or like football stadiums, things like that are not necessarily in the nicest areas, but that's where they're going. So they want to be able to walk there. They want to be able to take the train there. They want to be able to Uber there, So that's, like you said, proximity is so important. So those are the things that you have to look at as a business. You have to look outside of personal. You have to look at, the numbers and what people are really traveling for. What are some of your long-term investment goals?
Great question. Myself, I've already really kind of just drilled down on the niche that, I really want to focus on, specifically with multifamily commercial real estate. And, although I invest out of state, I do live in California. So my goals are kind of split. I'm living in California. It's expensive. I need a $2.5 million home in California. That's a huge goal for myself. I know I can get there. It's just going to take building my portfolio and building wealth over time. And I know that's something that, me and my wife, we definitely want for our future. But on the flip side, it's tough, right? Because, as my wife continues to partner with me on deals and really just invest in my vision and my strategy. And sometimes, in some cases, buying apartment buildings sight unseen, not even flying to the unit, not even touring the property, just doing our due diligence and kind of reviewing the inspection report, looking at a 3D inspection report and having some boots on the ground to kind of, check some boxes for us. It's tough, right? Because as I do want to replace, actually I've already replaced my corporate, salary. I want to continue to build that income. And me purchasing some, $2 million home in California is not going to contribute to the other goal that I have, right? So, I think it's a give and take, specifically in the situation that I'm in. Obviously the first priority, I would want to scale up to 50 units. Currently we're at about 17 doors and, we're actively, in deals and sourcing out deals as we speak. So the goal would be 50 doors. It's a beautiful thing when you're waking up on the first of the month and you have tenants that, hey, 60 or 70% of them are actually tenants through some type of nonprofit government assistance program via Section 8 or just maybe a nonprofit veterans program that, those deposits just come into your account, automatic. And then, hey, the other percentage of your tenants are actually paying you $1,000 of, just every month. So it's a beautiful thing when you understand the potential that you can bring your business to. And that's why I want 50 units. And I'm sure that number will, completely grow as I continue to scale. But on the flip side, I got a family in California. I need that $2 million house.
Okay. Those are the goals. And I love that it grows as you grow, because right, what you see in front of you, is kind of what you see, but as you continue to see things scale and you continue to see the potential, so should your goals, grow. So I love everything that you shared. Such valuable information. I know there's so many people that are like taking notes and like, okay, I'm ready to get started. But how can people purchase your book? How can they follow you and get this information in their hands?
For sure. On Instagram, the handle is Deeds with Dom. My website is deedswithdom.com. And then also on the website, that's where you can find the book, Don't Wait Buy Real Estate. Again, if you're listening right now, if you're out there and you want to get started in multifamily real estate, and you want to purchase your first apartment building, right? This is going to be the foundational blueprint to that. One, how do you determine where to find property, right? How do you figure out where you want to invest? Two, how do you analyze the deal? A lot of times we're looking at deals and we don't even know if it's good or bad, and we're just spinning our wheels, right? And then three, how do you fund the deal? How do you find, a lender, commercial lender to do that with? And how do you continue to foster that relationship with them so they can fund future deals? And, lastly, how do you find property management that's going to continue to take you through that process and make sure that your asset is properly managed? So my book is on the website, deedswithdom.com. And also, we also have just launched our merch line. I actually have a shirt on called Deed of Trust. So you can actually go out and visit that website and get some merch, and also pick up that book as well.
Awesome. Make sure you get all of that merch because it's just inspirational. I think, what you have on there is information of, it's inspiration to making sure that you are working towards those real estate goals and that you are working towards generational wealth. Everything that you shared with us today is so, invaluable. And the information in this book is key. I also want to highlight, you were recently highlighted with Clark Atlanta's, is it 40 Under 40, was it?
Yes, correct. It was the Young Alumni Achievement Award for 40 Under 40, and really excited about that. Really happy just to sit amongst 39 other individuals that were tremendously excelling in their careers and doing great things. It just really just hits home for me. I've been strongly, aggressively investing in real estate, and kind of just to see this all come full circle. It's just an amazing, just thing to see and experience. So shout out to Clark Atlanta. Clark Atlanta is definitely the reason that I am who I am today. They molded me into the person that I am. So for that, forever indebted. And the 40 Under 40 experience was definitely a day to remember.
Yeah, congratulations on that. Like you said, Clark Atlanta has built some great, phenomenal people who are doing great things. And I love to see it. It's so encouraging for young Black men, for young Black women, just for young people, period, to see everything that you're doing and seeing the possibilities. So thank you so much for sharing. A lot of people don't want to share this information. So thank you for not holding it and sharing it for the people to kind of gain the knowledge so that they can know that they have what it takes. You have the tools and you can do this yourself too. Start small and continue to grow and see where it takes you and build generational wealth. That's what it's all about.
Yes. Generational wealth, passive income.
Yes.
Don't wait by real estate, right?
Come on. Perfect plug. No, thank you again for being here, Dom. This was so great. Make sure you go follow Dom and all he's doing, purchase the book. And thank you everyone for watching. Thank you everyone for listening. This is Name a Better Duo podcast. We'll be here again, same time, same place next week. Have an amazing week. I'm your girl, Renee Nicole. You take care.